Hey guys, Darren Sugiyama here, founder and CEO of Landsmark Capital, the most transparent premium financing intermediary in the life insurance industry. So back in 2017, I was approached by an advisor that wanted to know if we could put together a program for a private university where the university could put life insurance policies on their donors and then have the death benefit assigned to the university. The university had a loyal pool of donors that wanted to do this. And though it looked like a great opportunity on the surface, I told the advisor that it's very difficult to quantify and justify the insurable need. In other words, life insurance carriers require there to be a reasonable connection between the entity, in this case, the university, and the insured persons, in this case, the donors. So I created a very different platform to accomplish a very similar outcome, but in a way that easily justified an insurable need and made the insurance carrier comfortable with this proposition. Now, at that time, this type of strategy had never been executed in the way that I designed it. And to my knowledge, no one has replicated this arrangement since then. So we implemented the program in 2018. And the university, their board members, their faculty members, and their donors were extremely excited about the program. And at their annual gala event, when they announced the implementation of this program that I developed, their total pledge donations that evening were over 3x over what they were at their previous annual gala event. I mean, people were excited. So the reason I'm doing this webinar on this topic now is that the university wants to do another campaign marketing this program to their donors again and install a second tranche of premium financed policies. A few months ago, I flew out to their campus and spoke to about 80 of their faculty members, their administrators, and I'll tell you, the excitement was really, really tremendous. So here we are again, installing tranche number 2. So in this webinar, I'm going to explain how this works, why it works. And so if you have any contacts in universities, private schools, charitable foundations, churches, or any religious organizations, or any 501c3 organizations that are interested in a creative fundraising technique, this is really a great way to create a long-lasting endowment fund. So there may be a way for us to work together, offering them something that they've never seen before. So without further ado, let's go ahead and get this webinar started. Okay, so in today's webinar, we're going to talk about how to use life insurance with a charitable intent. And we're going to review a case study. This is an actual real client that we implemented the strategy with back in 2018. This was actually a university, private university, where the university was the owner of the policies as well as the beneficiary of the policies, and the cash value and death benefit are intended to be used for funding things like scholarships, campus expansion, as well as an endowment fund Kickstarter. So let's talk about the concept of charitable plan giving. In the charitable space, oftentimes you'll hear the term pledged gift. And a pledged gift is a verbal commitment to donate a certain dollar amount over a certain period of time. So as an example, if a donor is making a $1 million pledge, that $1 million pledge could be in the form of 10 $100,000 annual donations over the course of 10 years, equaling a total $1 million pledge. So this pledged gift, again, is a verbal commitment. There's nothing contractual that legally locks a donor into this commitment. Again, from a legal perspective, this is more of a promise and an intention to make this gift over this period of time. So when I talked to the charitable plan gifting department of the university, I asked them a question, and the question was, if an annual gift of, say, $100,000 over the course of 10 years paid the premiums on a life insurance policy, would the so-called pledge be defined as the $1 million gift, or would the pledge be defined as the $3 million death benefit? Now, this is a very important question because, as you probably are aware of, when wealthy donors donate money to charitable foundations, 501c3s, in this case, a university, oftentimes the intention of the gift is rooted in them getting some sort of social recognition, and sometimes to perpetuate the family name in the years after their end of life. Now, I've also asked the same question to other 501c3 charitable foundations, and they all gave me the same answer. And that is that the so called pledge amount would actually be the ultimate gift that goes to the charitable foundation, not necessarily the dollar gift that the donor donated out of pocket. And so this really got me thinking about how can we amplify the ultimate gift going to the charitable foundation by using premium finance life insurance as opposed to a non-finance life insurance policy. Now, this non-life insurance policy is just an example of a male age 60 preferred non-tobacco with a $1.6 million face amount that ends up being pushed up to $3 million in net death benefit at age 86, assuming age 86 is life expectancy. Again, and this was using a non-finance 10-pay design. So the question is, with using the same outlay in one of our premium financing designs, in this case, partial equity interest accrual, we modeled that same $100,000 annual gift over the course of 10 years, and using that gift to pay a partial premium, financing the remainder of the premium, and accruing interest on the borrowed premium. And for more details on that specific premium financing design, you can go to our website at landsmarkcapital.com. But in this particular design, at age 86, the death benefit net of loans using the same index return produced a net $4.3 million in death benefit, as opposed to just $3 million in death benefit in the non-finance policy. That resulted in a 43% greater net death benefit outcome. Again, that would be the ultimate gift that the charitable foundation would receive based on this particular proposition. So, as I talked about in the beginning of this webinar, mixing life insurance with a charitable intent has its issues, and in many cases, carriers are not thrilled with the idea of using a life insurance policy for a charitable purpose. So, let's walk through the problems with this particular scenario here. The first one is that if the donor pays for the cost of a life insurance policy on himself, there is no immediate tax deduction benefit and also no social credit. So, in other words, if a donor were to just buy a life insurance policy, own the life insurance policy themselves, and then later assign the death benefit to the charitable organization, well, those premiums or those interest payments paid would not be a charitable deduction for the donor. They would only realize a charitable tax deduction for that gift at their end of life when their trust received the death benefit and then the trust donated the death benefit to the charitable organization. Or obviously, if they own the policy themselves and the beneficiary was, say, the insured spouse, the spouse would then make the charitable gift in the form of a donation to the charitable organization, and then the spouse would get the tax deduction for that charitable donation. But again, in that situation, the donor would get no immediate tax deduction for contributing to the life insurance policy in the form of either paying premiums or paying interest on borrowed premiums. And again, as far as the social credit, they would receive no social credit because technically there is no proof that that donor is actually going to make that charitable donation at the end of life when the policy's beneficiary receives that death benefit. Now, another problem is that even if the donor assigns the death benefit to the 501c3, they could, in fact, change the beneficiary at a later date. And if they did that, the 501c3 would lose out on that charitable donation. So, again, if that 501c3 were to recommend that a donor put a life insurance policy on themselves and then, again, make that charitable gift to the 501c3 at their end of life, there is no guarantee that that 501c3 would be the recipient of that death benefit gift. Now, as we talked about earlier, again, carriers do not like mixing the purchase of a life insurance policy with a charitable intent upon purchasing the policy at the point of sale. And the reason is really more of an optics issue than it is a legal issue. And what I mean by that is, optically speaking, if anything goes south with the life insurance policy and either the insured, the donor, or the charitable organization becomes unhappy with the outcome, the carrier could be mentioned if the media were ever to get a hold of the story. And all of a sudden, the carrier incurs reputational liability, not necessarily legal liability, but certainly reputational liability in the form of reputational damage. Now, what I have heard several people do, in spite of all these other challenges, is they try to have the donor make the charitable donation or the gift immediately to get the charitable donation deduction and have the charitable organization insure the donor as a key person. Again, the problem with that is that if the donor makes a charitable donation to the 501c3 and the 501c3 tries to insure the donor based on their history of donating, it becomes very difficult to justify a legitimate insurable need. Again, carriers are not fans of this type of strategy. So, given all these problems, we have come up with the solution. And this is a proven solution. This is not just philosophically speaking. We have actually installed this particular strategy in a private university. Again, this was done back in 2018. And so let's talk about how this was structured. Again, structured in a way that was pleasing to the carrier and accomplished the goal that the charitable foundation was looking for. Again, in this case, the private university. So, what we did here is we went to the donor base and we said, okay, if you folks make a charitable donation to the university, you would get an immediate charitable tax deduction, just like any normal charitable gift. Your charitable gift could go into a restricted fund within the university, and that restricted fund would be specifically to fund the purchase of life insurance policies. Now, in this case, instead of putting the policy on the donor, we structured it so that the university put key employee policies on their faculty members. So, from an insurability justification standpoint, these are nothing more than key employee policies. Kind of par for the course in any private sector for profit business where the company would insure their key employees. Now, in theory, those policies could be purchased non financed. Obviously, we are in the premium financing business, and so we have a bank that would step in and pay the premiums for the nonprofit organization. And then the restricted funds that were funded by the donor donating those funds to the nonprofit organization, the restricted fund would make the annual interest only payments to the bank. And that's if they were using our first dollar financing platform. If they were using our partial equity interest accrual platform, or our second year financing, or third year financing, or our sixth year financing platform, those annual payments might be in the form of partial premium payments, as the bank would fund the remaining premiums and the interest due would be accrued. So, again, depending on the culture of the nonprofit organization, what their risk tolerance is, what their liquid assets look like, all those factors would be taken into consideration when designing the proper premium financing loan model for that particular organization. Now, these key employee policies could be used by the charitable foundation using the existing cash value net of loans after the premium financing loan is paid off while those participants are still alive, or the foundation could wait until end of life of those key employees and the net death benefit would pay out to that foundation. So, from a cash value standpoint, you could look at that as part of their overall portfolio within their endowment fund, or you could focus more on the death benefit being more of a legacy gift type of design. So, this type of structure could work again with a private university like the one we did. It could be within a church, a synagogue, or some type of religious organization. It could be a charitable foundation. So, if you have a relationship or an opportunity that might want to take a look at this, you can obviously reach out and contact us here at Landsmark Capital to discuss the details. But let's go ahead and get into the actual case study, the private university that we implemented this strategy with back in 2018. Again, it was a private university. We insured 23 college professors and we got them guaranteed issue. So, several different carriers have these types of multi life guaranteed issue programs. Most of these guaranteed issued programs require a minimum of 10 insured people. And those 10 insured people have to typically be in the same employee class code and have similar salaries. So they're looking for somewhat of a homogeneous group that's being insured, and this really prevents any sort of adverse selection. There's also a maximum age as well as a maximum weighted average age. In other words, you wouldn't be able to insure someone that was 99 years old. Typically, the maximum age to be included in this guaranteed issued group is right around age 70. Again, that varies from carrier to carrier. And then the maximum weighted average age needs to be under a certain age as well. And again, every carrier has a slightly different set of parameters and requirements in order for a group of employees to be issued with a guaranteed issue rating. And that guaranteed issue rating is typically standard non-tobacco. In addition to that, each carrier has a maximum face amount per insured person. Usually that maximum face amount ranges on the low end about $1 million and on the high end can get up as high as $3 or $4 million. Again, depending on the carrier and depending on the unique situation. And that's part of what we do here at Landsmark Capital is we will shop this out and find the appropriate carrier with the appropriate underwriting program that best fits that specific client's needs. Now, with this particular private university, the really interesting thing was that they actually built in a personal benefit for these professors as well as a benefit to the university. Now, because this falls into the non-qualified space and is not an official deferred compensation arrangement, the university was able to co-design this with me per their specific requests. They decided that they were going to gift 20% of the net death benefit to an assigned beneficiary of the insured's choice. So, in other words, each insured professor was given the choice of who they wanted that 20% of that death benefit assigned to. Most of them assigned it to their families or their spouse, obviously. And then 80% of the remaining death benefit would be assigned to the university department of the insured's choice. In other words, the professor could decide whether they wanted that 80% of that death benefit to be assigned to a particular department, like the English department or the athletic department, or even to a specific fraternity or sorority. Now, this particular design of this program really got the faculty members behind the program. Obviously, for the selfish purpose of having 20% of the death benefit going to their loved ones, because this did not cost the faculty members anything out of pocket, right? This was fully funded by the university, but it also empowered the professors or the faculty members in the sense that they could leave this legacy gift behind to something that they were passionate about within the university and have their name tagged to that project or department, receiving that gift based on their end of life, kind of like a tribute to what they contributed to that university during the time of their employment. Again, this cost the faculty members nothing. This was fully funded by the university. So the university funded the cost of these policies using that restricted fund that was originally funded by the donors. So again, from an optics standpoint, the overall program is essentially just key employee policies on the faculty members, the professors and the administrators. So very clean in terms of the insurable need and the justification of putting these policies in place. The way these key employee policies were funded was actually rooted in the marketing of this program to the university's donor pool. So clearly, the faculty members really got behind this initiative. The university really got behind this initiative due to its creativity and, quite frankly, the indisputable mathematical benefit of using this type of strategy versus putting that in a standard managed account. But what got everyone really excited was how this was received by the donors. So they announced this in 2018 at their annual gala event. And that evening, largely as a result of the excitement that was built around this program, the university's gala event produced 4 times the pledged gifts that night compared to the previous year's annual gala event. 4 times. That is huge. I think the reason why the donors got so excited about this was a really creative and progressive way to do something long-term for the benefit of the university. Oftentimes donors, they want to know that their donations are not just going to pay some bills in the short term, that their gifts would create a long term, long lasting benefit that would perpetuate their family's name, linked to the long term sustainability of that charitable foundation. Again, in this case, the university. This is all built around a legacy gifting model, not just a short term fundraiser. Big difference, not only in the ultimate financial value, but also in the perceived value from a cultural perspective. And by cultural, I don't mean ethnic culture. I'm talking about the culture of the organization, the mindset of the organization, the philosophy of the organization, and how those donors want to be remembered from a legacy standpoint within that organization. And so this year in 2023, the university is funding a brand new group of professors. Again, this will be the second tranche of key employee policies, again, all premium financed. So, the big reason why this program is received so well is that we understand, what they call with them, right? What's in it for me? We understand what's in it for the donor. We understand what's in it for the organization. And then we also understand what's in it for the people that work in the charitable plan gifting departments within these organizations. So let's go through what the benefits are for each one of those three entities. For the donors, obviously, they get the immediate tax deduction, which is a huge part of why charitable donors like to make donations. They like the tax deductions. The second thing is that they get the social credit of the death benefit, which is approximately 3 to 5 times greater than their actual cash pledged amount. So they're getting, again, 3 to 5 times the credit than they normally would get by making, well, I guess what I would call a normal charitable donation. Now, the way I would normally recommend that this be marketed to the donor pool is that the donor would be able to dictate which cause or which project within the charitable foundation that their legacy would be attached to via the restricted fund. In other words, the donor could dictate exactly where they wanted the ultimate gift of the death benefit to go to. Now, in the example of the private university that we installed this strategy into, they decided to flip it around a little bit, where they marketed this concept to the donor as a more efficient way to multiply the donated dollars into a death benefit, which would create a greater financial outcome for the university. And then instead of having the donor dictate which cause or project that those funds would go towards, they empowered their faculty members to decide which cause or which project the ultimate gift of the death benefit would go towards. So there's several different ways that you can position this. Again, a big part of this is understanding what the culture is of that charitable foundation and what would excite and motivate all participants within this type of strategy with that specific organization. Okay, and so for the 501c3 or the charitable organization, in this particular strategy, they're going to own the policies even if the key employees leave employment later on. So they're going to pick the plan participants, the actual insured people. Again, there has to be a legitimate insurable purpose in the form of a key employee policy for each of those participants. And once those policies are enforced, even if that employed person leaves the employment, those policies still stay in force. The organization still owns those policies. They can still control the net cash value of those policies, and they would still be the beneficiary at end of life of that departed ex-employee. That ex-employee's policy would almost be considered like a cash value surrogate or a death benefit surrogate if that particular person leaves employment. So there are no issues if that person leaves employment. The organization would obviously control the net cash value, again, as part of their overall endowment fund. So the cash value of the policy is really looked at as a liquid asset once the premium financing lender is paid off. And depending on the type of policy that you use, whether it's whole life or indexed universal life or whatever it may be, we happen to use indexed universal life with that private university. The nice thing about that particular underlying product is that you're dealing with a floor and a cap. The 0% floor really provides principal protection, downside protection in the event of a market crash. Typically, board members of charitable foundations really like that concept because they are focused on preventing losses. Yes, they want gains, but they are actually more focused on preventing losses than maximizing gains. In a typical endowment fund, the target goal of an IRR on an annual basis is not that high. You'd be shocked at how low the expectation is. And the reason the expectation is so low is, again, they're playing it safe. And so they might have a larger bond fund allocation within that endowment as opposed to trying to swing for the fences, being more heavily weighted in equities, again, because they are trying to diversify and mitigate or minimize their losses. Now, obviously, these key employee policies are set up so that the charitable foundation receives the death benefit of the employee's policies at their end of life. Now, these two entities, both the donor and the charitable foundation, what's in it for them is pretty obvious. But what a lot of folks really do not understand in terms of the culture of these organizations is understanding what the charitable plan gifting department heads do for a living, what their goals are, and how their success is measured within the charitable foundation. Now, within a university, understanding how these department heads think and how they operate is so important. A big feather in their cap is that this type of program provides them with a new, exciting fundraising strategy for them to promote to their donors. All right, they're always looking for new things to talk about with their donors. They're always looking for a reason to get back in front of their donors, other than going to them and just asking them to kind of blindly write another check. Using this premium financed funded strategy is an exciting new idea that they can go and really justifies a reason for them to meet once again with their donors to share with them something new. Now, the other thing about understanding the culture within these charitable plan gifting departments is that the people that work in these departments, they are almost kind of sort of like salespeople in a sense, right? I mean, their job is to call wealthy alumni, if it's a university, call wealthy donors, and essentially try to convince them to donate more money. Now, these employees that work within these departments, they're almost given kind of sort of like quotas, the way a sales team would be given quotas. And so the folks that work in these departments are judged on the pledge amounts that they can secure with their donors. Well, if the pledge amount is defined by the ultimate gift that the charitable organization is getting, in this case, the death benefit, that death benefit amount is typically going to be somewhere between 3x to 5x greater than the pledged dollars that the donor is donating. The employees that work inside these charitable plan gifting departments are getting credit for that ultimate pledge of the death benefit. Again, they're doing the same amount of work, but they're going to get credit for 3 to 5 times greater the outcome of the actual dollars that the donor is pledging to go into that restricted fund to then fund the premium financing life insurance policies on the key employees. So, in summary, here, really the key to this program is understanding the culture of these 501c3s, right, of these charitable organizations. Again, whether they be an actual charitable foundation or a private university, or quite frankly, it could be it's a private school, doesn't necessarily need to be in higher education. It could be a private high school, could be private middle school, et cetera, et cetera. But it's really understanding the driving, motivating factors for all of these three parties involved: the donor, the charitable foundation, and the employees that work inside the charitable plan gifting departments within these charitable foundations. So I've had these really unique experiences that have contributed to my ability to pull all of this together, right? Not just being an expert in life insurance and premium financing, but also having hands-on experience working with these types of charitable organizations and understanding the culture within. So I don't know if you've ever seen the movie Slumdog Millionaire, but in this movie, the main character grew up in the slums of Mumbai, India, and had a litany of seemingly unrelated experiences. At the end of the movie, he finds himself on a TV game show, and the questions he gets asked, which no one would ever know these answers, especially a kid that grew up in extreme poverty in India. But due to his unique experiences, the questions just so happened to line up with his personal life experiences. That's kind of the situation I find myself in today with this charitable premium financing program. I've sat on boards of charities, so I understand the culture of 501c3s. I have close friends that have worked inside these departments at universities, and I've already executed this program successfully with this private university we discussed today. And most of all, I know how to structure this multi-life premium financing platform in a way that is responsible, compliant, transparent, and on top of all that, not too shabby at presenting in front of large groups of people either, if I do say so myself. So if you have a charitable organization that's looking for creative ways to build an endowment fund with ROIs that exceed or can exceed equities returns, with a stop loss feature that can be even safer than bond funds, contact us through our website at landsmarkcapital.com, and we can set up a private Zoom call to discuss your potential case.